very privileged to have with us Mr. KV Kamath, former head of ICICI Bank, also chairman of the Expert Committee on Resolution Framework for COVID-19 related tests, that has just submitted its report, a report that is currently the cynosure of all eyes, especially of bankers and borrowers. Thank you so much, Mr. Kamath, for taking time out to speak with ET Now. Given the RBI guidelines on resolution, the account should be standard, restructuring should only be if the stress is related to COVID, financial ratios that you have specified in your report should be adhered to, resolution need to be agreed to by bankers, accounting for 60% by number, 75% by value, then it needs to be vetted by your committee if it's more than 1,500 crores, a rating agency if it's more than 100 crores. Are these conditions all too stringent? And do they effectively rule out restructuring on the scale that is required? In fact, your committee report, that matrix shows that only about 25% of the borrowers would be really eligible. So given the scale of the pandemic and the scale of restructuring that is required, does this really go against this need to restructure on a much larger scale, Mr. Kamath?
Again, let me put things in context. I think what the boundary conditions that the Reserve Bank have laid down, I think is I think very well defined. And if you look at the number of the eligible amount as on March 1st, which is the definition that the Reserve Bank has given, I think it's a substantial sum. If you look at the sectors that could be impacted, I think we are looking at almost within that sector, we are looking at almost 47 or 48 lakh crores of assets, which are performing, but if they are impacted and the banks and need to do a restructuring, to do a restructuring. That's a substantially large number. Within that, the number that we are talking of, 60% of that falls in these 26 sectors that we have looked at. The balance is in other sectors for which we are given a general principle. I would think that within this, the pain, clearly, if you look at the quadrants, in one sector there was pain a priori. That is the top right quadrant. But these assets were still performing as on that day. And there are, that quadrant, there are assets which would come back to capacity very quickly. So I would think that at this point in time, yes, in the first quarter of this year, almost evenly across all sectors, there was pain. But as the economy starts improving from the second quarter of the year, as is expected, I think pain will be alleviated. So we would believe that the pain that the system could have is going to be much less than what it probably was thought of in March. And the window that the Reserve Bank has given gives an opportunity to the banks to address this pain.
Good to hear, because you have done a remarkable job of identifying the 26 sectors that need specific treatment and the 5 parameters that bankers need to keep in mind. But do the recommendations in some way, the financial ratios, straitjacket the backs when it's come to lending? Because you could well have a borrower who is marginally out of the ratio, but actually is much more likely to make it than somebody who strictly complies with the ratios. Because banking does involve some element of judgment. Would you not agree?
I agree entirely. And actually there is a solution for that given the leeway. See, for example, that somebody cannot meet, let us say, the ratio, the debt service coverage ratio, for that particular period, a rescheduling could be done. And I would expect that these challenges would be in the first 2 years. And that is where the scheme outlined by the Reserve Bank gives banks no prescription as to how they should do it. As long as they do not exceed a 2-year period, within that, they have the freedom to do to design the repayment and the terms so that least pain is caused to the client. And I would think that the banks will skillfully do this over a 2-year period, the first 2 years where the pain could be most, so that thereafter the company is able to perform.
Okay, so you mentioned the DSCR, the debt service coverage ratio, but in fact the DSCR depends heavily on the projected cash flows. And at a time like this, projections could go wildly or fault bankers the projection and subsequently being proved completely wrong, particularly because they've seen the kind of harassment that goes on if an account turns NPA, because the projections turn out to be way off. And at times like this, it's almost impossible to predict what the cash flows would be like. So does it really entail some element of on bankers, which perhaps today they might not be willing to take?
No, I think you raised a very important question. And the way the bankers could handle this is follows, and that was thought of during our deliberation. So let us take the situation that you described, where in a particular year, and that would be, I believe, the first 2 years, the cash flows just are not enough to give you that unity, that is debt service coverage of 1. What should the banker do? The banker in that year should have less of a repayment, and that leeway the Reserve Bank has given. So you set the repayment schedule in such a way that payment during that year is lower than what it would have been. But it is lower to an extent that the debt service coverage, interest and repayment in that year is at the threshold of 1. Later on, when the profitability improves, the cash flows improve, you increase the that is due for repayment, or the repayment due in that particular year. So this leeway, the banks have a complete freedom to do. And I think that is something very elegant that the Reserve Bank did a priori without setting prescriptions.
The only problem is that when Reserve Bank inspectors go, they very often second guess with the wisdom of hindsight. And that puts bankers in the past and even today, that's what makes bankers very wary. Because banking is essentially about the business of taking risks, informed risks. But in this method, does it take away the very essence of banking and merely end up by ensuring that bankers focus on ticking the boxes regarding the various ratios? And we all know that creative accounting is a huge possibility and is often resorted to. So in this case, is there a risk of that happening, Mr. Kamath?
There are two checks and balances which should minimize that risk. One is the banks themselves should be satisfied that post the restructuring that is done, and the accommodation that is given in terms of repayment and or are there any structures to be brought in, the company is viable. That is level 1. Level 2 is in a case which is over 100 crores, then you need the rating agency to come in and look at the whole proposal. So I think there are 2 layers of checks here which should provide comfort to both the banker and the client.
In the process of having checks and balances in order to kind of prevent a rise in NPAs, which are frankly inevitable in banking, you can never completely foolproof the system. Could it result in a kind of abdication of responsibility by bankers, since the resolution plan has to be vetted first by your committee in the case of large accounts over 1,500, and as you mentioned, in the case of more than 100 crores, you have a credit rating agency also coming. So the bankers are one step removed, and the whole thing becomes very bureaucratic. Is that a possibility?
Well, it will depend on, what is the bank's intent. If the bank truly wants to set its books right and the clients help the client to set its book right, I think the bank will have to be the first mover to get this ball going. And I would look at it as an opportunity given, which a true banker will seize, because otherwise he's going to cause enormous pain to his own balance sheet, to his own institution, and to the borrower.
You've admitted, Mr. Kamath, rather the committee report has admitted that actually resolution plans take months. And very often, in fact, unless you lend at the right time, the very purpose of a resolution plan is lost. But in this process of checks and balances, isn't the entire process likely to be delayed even more? Because earlier, when you did not have a committee vetting, you did not have a credit rating agency, etc., it still took such a long time. So are we going to be a bit too careful, and in the process, taking away the very essence of banking, which is taking calculated risks?
Again, it's a very good question. And generally, yes, this has been observed, and that is why it is there in the report that these have taken a long time. I think there is two differences here. One is typically you do this sort of a thing for a company which is in distress, which has a whole lot of, I would say, comorbidities. Now, in this case, these companies, by and large, did not have those comorbidities. There is a morbidity at this point in time which has to be addressed. So that makes life a little bit simpler than what it typically was. I think the Reserve Bank, by setting the boundary conditions in the August 6th circular, put very clear time frames. So if a bank wants to clean up its own balance sheet in context of making or ensuring its assets remain healthy and the client is facilitated, then within that boundary condition, you will have to operate. So unlike past resolution plans which took its own time and defeated the purpose, I think given the boundary conditions here of tight timelines, I would expect people will move with speed. Let me say this. The Reserve Bank has acted with great speed in bringing out the August 6th circular. We, I think, as a committee, and I have to thank my colleagues for this, worked at speed to make sure that what was required was articulated within the time frame, and the Reserve Bank has notified it again within the time frame. And I think timelines are now clear to every participant, and I'm sure that even as we are speaking, hopefully they are working on this on it to get their policies right, because that's the first thing that banks have to do, and then get the list out of cases which are under stress and start lending. So having had a dialogue with the lenders, I believe they are all aligned, and they are trying to work at the same pace that the Reserve Bank expects them to, to make this plan a success. So, because I can't second guess them, but my belief is they will work at speed this time.
I do hope you're right on that, but the RBI wants these resolution plans to be in place by the end of December. How realistic is that?
I think this was something that we went through. In fact, I can say this, that we did mock drills ourselves within the committee, because we had, I think, a lot of wisdom from our colleagues in the bank who have all, headed banks and seen what happens. And we did this mock drill amongst ourselves without talking to then we, in a way, back-tested it by asking the team members from the lending institutions who were there whether this was feasible. And I think if we set our minds to it, it is feasible.
Okay. Rather than going through such a, if you pardon my use of the word, the convoluted mechanism, would it not have been simpler if the RBI, government, and everybody were to come out very clearly and say that all acts done by bankers in good faith and without negligence, so there's a standard term which is used in banking, will not be from the perspective of vilified, there will not be any victimization, because as I said, NPAs are inevitable in banking, whereas currently we have a situation where we proceed from the premise that the banker is guilty. So all acts done in good faith without negligence should not be from the point of view of vilified and of victimization of bankers should not follow from that. Would that not be a simpler thing, and would it not give bankers more confidence?
That's a call that the government and the regulator has to take. I think without that in place, I think every banker will try to see that there are enough checks and balances to make sure that the process was appropriately followed. And I think at this stage, that is probably what is available. But the suggestion that you made is something that the government could be considering.
Okay, because the fact is that unless bankers have that confidence, they'll just keep on putting money in G-Secs or giving it to RBI in reverse repo. In fact, I also wanted to ask you that would recapitalization of public sector banks, would that make a significant difference to credit offtake and willingness of bankers to lend? Do you see that as an alternative? And could the government recapitalize them outright? Could it set up a bad bank? What is the means that we have to set the credit wheels churning once again?
We'll have to look at it at probably 2 or 3 parts. The first part is I think there was a cleanup already done. Now, if this current exercise and the current pain results in need for capital, that will have to be addressed. Now, that's where the question that you raised comes in. Would it better to pump that capital in and will lending take place, or is it better if we were to create a bad bank? Now, I think there are several models of the bad bank. The bad bank has worked, but a priori, a few questions need to be addressed while setting up that structure. A is how are you going to capitalize that bank? What will be the governance structure of that bank? And B, how are you going to fund it? Because if the assets are taken out of the existing banking system, they have to be recompensated. Now, even if it is paper, you need to make sure that on the due date, that paper is honored. So unless these parts are thought through clearly and then put down, I think we are probably not going to get this fix of the bad bank. These are the 2 alternatives: capitalize the existing bank or move assets into a bad bank. Now, the bad bank example elsewhere, as I've seen, either runs on basically selling the asset to a player who has the funding ability and who expects the assets to be bought at maybe a few cents to the dollar, or basically handing it over to an entity which is supported by the government again. So again as the government coming in, which gives it enough leeway for that asset to be put back to productive use. And this example particularly has been seen, for example, during the 2000 crisis that was seen in China. And even in recent years, they have done this where equity type of structures have been created and held in a separate structure. But these structures are all, in a way, government handheld. And I would say government strongly handled by the government. So we need to have clarity as to what is the latter type of structure, the bad bank type of structure we want to create, and then proceed on this basis. But unfortunately, if a bank runs short of capital, the regulator will want that capital to be brought in very quickly. So these things will need to be addressed very quickly by the policymakers and the decision makers.
It's a tough time, both for government and the regulator. But my last question, sir, before I let you go, is that how do you see the economy? How hopeful are you? What kind of a recovery? Because the government has been talking about a V-shaped recovery, but the V-shaped recovery is only from quarter to quarter, because the last quarter, the first quarter of this fiscal was very bad. So almost any kind of performance would be a sharp upward uptick. But I'm talking about a more sustained kind of recovery, the kind of recovery that will see banks also recover, because ultimately it is a rising tide that lifts all boats. So how do you see the economy?
I think you raised a very valid point. I think at this point in time, having seen what happened in late March, April, I was in despair. Things have indeed improved at a rate faster than what, or a pace faster than what I had anticipated. But I would be a little bit wary at this point to label it either a U or a V. What I am expecting is that we will certainly see quarter-on-quarter improvement based on what industry leaders of various types of industries, whether heavy, light, or whether small scale, are talking about. And I would think that watching not every quarter, but virtually every 15 days to a month would probably give us the right answer. The observers the right answer. So I would not be saying whether it is a U or a V, but clearly there will be a recovery which is continuing at a fair pace between now and March. And at that point of time, we will probably be able to characterize it. Was it a U, which would mean that it had a long flat position. It is obviously not having a long flat position. That was, the bottom of the U was probably one quarter. After that, it is going to, tend up. Now, what will be the slope of that? We will know after looking at one quarter, and then may be able to make a call whether it is going to be a V or it's going to be a shallower rise. But one thing is very clear from industry commentary that I see, that the recovery is faster than what we thought of. And the other thing that is clear, Mythili, is that what we could not achieve, that is on the use of technology at the retail layperson end, not the retailer end, retail layperson end, and the extreme other end I use is the farm end, the layperson in the farm. I think that has happened at a pace which we never anticipated. So that has to be factored into the next 9 months, is that we have found probably new ways of doing business. At one end, the technology end, the corporates in their way they have done business, their own factories, and in the offices, the way business is done. So we are going to have an interesting 9 months observing how the shape of this recovery, what shape this recovery takes, and what are the positives that come out of this recovery. So I'm all excited to look at the next 9 months.
Yes, you're right on that, because there are some positives even from something like COVID, because digitization certainly has proceeded much faster than we ever anticipated. But now that I have you with us, Mr. Kamath, I have to ask you just one or two more questions. This is basically regarding the policy initiatives, because any country basically has just two policy instruments, monetary policy and fiscal policy. We've seen that the Reserve Bank of India has been fairly proactive as far as monetary policy is concerned. Is there a sense that fiscal policy has not contributed its might? And what could be the reason for that apprehension, that fiscal policy? So I have two questions. A, do you think fiscal policy has not contributed as much as it should? And what could be the factors holding government back?
I think, again, as a layperson, I would look at it this way. that it was very clear that there would be a sharp drop in GDP for the quarter and for the year. And some numbers have been put out. I broadly would agree with probably that's what's going to happen. I think the government has looked at the consequences of that on their own fiscal situation and probably decided what is the pain that they could take and impose on the system in this context. And whatever solutions that have been worked out so far have been worked out, I would use the word skillfully, keeping this in mind, the pain and the amount of pain that the system and the government could take. Now, luckily, and this is where I think an interesting thing happened for India, we had systemic liquidity for a variety of reasons. We won't go into that. Why didn't banks lend in the past and so on? And you aptly put it, banks put the money back to RBI. But given that sort of a situation, things could be done by using that liquidity. So I would think that this has been very interestingly done. And what the government then used was the grain stock that they had as a stimulus measure. And I think very rightly so. And I think that has met its purpose. And by November, that will probably end. So I would, as again, observer, stepping back and watching the government, I'd like to say that the measures that have been taken have been done in a very interesting manner. I have not seen these measures done elsewhere in the world, but they are effective because I think they have elevated the pain. And now the steps that the Reserve Bank is taking should help us move on to the correction path.
Yes, you're right. As far as fiscal policy is concerned, Government of India has been a bit of an outlier, whereas monetary policy, we've been more or less in tandem with other central banks. Is there
Indeed.
some further scope for monetary policy? Because as it is, if you see, interest rates are negative. So savers are actually feeling the pinch. Do you see this impacting household savings? And that could have a larger implications for the economy as a whole. So what can monetary policy do? And is there a danger if interest rates continue to be negative, real interest rates?
I would agree with you in the sense that the tools there could be limited on this interest rate front. But again, I heard the governor say that he has tools, still tools that are available, and I don't want to second guess on that. And I'm sure those will come into play if needed in due course.
Okay. So thank you so much, Mr. Kamath. It's been great hearing you. So much for explaining the logic and the rationale of the committee recommendations. And with that, it's back to the studio.
Thank you.